Good afternoon, all, and welcome to the Real Vision Daily Briefing. I'm Andreas Steno, the senior editor at Real Vision, and it is my pleasure to host the show again. We are sending to you live the 26th of July on a day where the IMF sounded the alarm on global growth. Stocks are lower on the day, with Nasdaq suffering the most, being down almost 2% ahead of the extremely important decision from the Federal Reserve tomorrow. And with me today is an avid central bank follower and also a senior markets editor at Real Vision as well. Weston Nakamura, it's very good to see you again, buddy.
Andreas, my man, how are you? Thanks for having me on.
I'm good. It must be early for you, mate. You're in Tokyo, right?
Yeah, you could say that's 5:01 a.m. So it's usual RVDB time for me.
But let's get to the top story of the day, Weston. The IMF slashes global GDP forecasts, and they actually revise global growth down by 0.4% this year and 0.7 percentage points for next year compared to the April projections. Do you think the IMF is right in sounding the alarm on global growth?
Yeah, I mean, I don't think that they're particularly being contrarian here. I think that there's a lot of, markets themselves, last time you were in IRR and we were talking about, is the market shifting from inflation to recession and all that? At the time, I was saying, I think for a few weeks that's been kind of being priced in, and a few weeks hence, certainly being priced in. So I don't think that they're necessarily off base with all this. What I think is interesting, however, is that at the same time they're still saying central banks need to tighten policy where appropriate with rampant inflation.
Yeah, that's quite an interesting cocktail. And let's debate the central banks, because we have a big week upcoming with the Federal Reserve decision tomorrow, etc. If you look at central bank pricing right now, it seems as if the market is extremely uncertain in terms of the outlook for the Federal Reserve. What do you make of the meeting tomorrow and the pricing?
Sure. So let me just walk you through what I'm watching with the yen. Okay, this is regarding the Fed. So for the Fed, the reason I'm watching the yen is because shorting the yen has been the global macro trade of 2022, or at the very least, short yen or long dollar yen has been a Fed trade, if not the Fed trade. I'll talk about this in my last Bank of Japan video, which is a kind of full look back at the first half of this year, since I flagged BOJ, as this rogue central bank to watch back in January. The video is called "How BOJ Blew Up Markets 2022." It's on Real Vision YouTube. Please watch that if you want a detailed overview of what happened so far and where I think we're going to go through the lens of BOJ and yield curve control. But basically, so regarding the short yen being a Fed trade, the reason is because normally rates traders would bet on front end rates, usually using Eurodollar futures. Just note, those who are unfamiliar, Eurodollar futures are short-term interest rate derivatives, not to be mistaken with the euro. This is not a currency instrument. It's completely different. So normally rates traders, they would bet on where they expect Fed funds will be priced and at what level and when, et cetera, right? But Brian, chart one. If you take a look at these two charts that I have, the top chart is implied volatility on Eurodollar futures. Bottom chart is just the price of yen futures. So for the past several years, both Eurodollar implied volatility and the yen have been relatively flat. Then starting around 2021, and then really ramping up in 2022, we have implied vol on Eurodollar futures skyrocketing to insane levels. And that surge in front-end rate vol is a direct reflection of Fed policy uncertainty. If you wanted to quantify and chart out market uncertainty of Fed policy, that's what that chart would look like, right? So rather than traditional outright bet on Fed policy, traders instead have been playing a relative trade. Hawkish central banks against the lone dovish central bank, which is staunchly capping its sovereign yields, which is obviously the BOJ and the JGB market. And so this policy divergence trade, or shorting the yen, is being massively piled on, and you can see those kind of splitting off in tandem at this more or less around the same time. And Brian, chart two. This is a massively crowded trade. So this is asset managers' largest net short CME yen futures position on near record. It was a record just a few weeks ago, but it's still basically there. Massive yen position. You also have Japan retail, who is a big force and lever at FX day trading, and certainly can impact markets. Japan retail simultaneously has the largest net long USD on record. So everyone is on this like short yen trade. And then now regarding this shift of markets positioning from inflation shifting to recession. So I also mentioned this in the BOJ video, but first of all, my view, at this moment, there is nobody who wants an overly hawkish Fed to break things more than BOJ Governor Kuroda. Because although the Fed and BOJ policy divergence is what's been killing the yen and causing Kuroda all these headaches, at this point, Kuroda's best scenario would be for the Fed to hike and to suffocate the economy and break things, and then get a bid back into bonds. JGB yields come down on their own without central bank intervention. Dollar yen comes down, and Kuroda, who's been on hold this whole time, looks like some sort of, like hero as markets, the economy came back to him, right? And this is also what he's kind of betting on staunchly by defending yield curve control. Like, he needs a recession before his term ends in April 2023. And then chart 3, Brian, as of late, markets have continued to shift from inflation to recession concerns, repricing particularly in Europe, and this is where you can call it as well. But like, this is like, the Euro Swissy rate, sub 100 or sub 1, just broke through that 1 level into like the 99 handles, and now it's hitting record lows even today. So basically, if the FOMC and Powell, if they aren't as hawkish as expected or as priced in, we can potentially see a rush to close these short yen positions on this U.S. to Japan policy divergence profit taking. And so the play for me would be, if you are going to do that, either as a hedge or as an outright bet. Chart 4, Brian, is to short the euro rather than short USD JPY. So you short EUR JPY instead of USD JPY, because the euro remains relatively strong versus the yen. It's been getting killed by everything else, but versus the yen, it's still pretty buoyant. But it is topping out. And with this is another thing I want to talk to you about as well and get your view on. But with this recent ECB's TPI, as I call yield spread control, which you have a more funny name on, but which basically, it makes ECB more in line with BOJ's yield curve control than with the Fed, even with ECB's front-loaded rate hike. So that policy divergence between the ECB and the BOJ, that needs to close up via Euro JPY. So that's how I'm looking at it. So I'm going to be actually looking at, obviously, all, cross-asset, all instruments, but specifically Euro Yen with the Fed tomorrow.
If we look at the yen trade, I have to admit that I perfectly agree with it. I have to trade on myself because of the risk reward of the trade. If we look at a couple of scenarios, if the Federal Reserve is extremely hawkish, there is a potential risk that they break equity markets into the autumn. I think that's ultimately a good thing for the yen if the Fed really manages to break assets in a violent fashion. But if they surprise on the dovish side, then I also think that we should expect a rally in the yen as a consequence of the positioning that you just depicted. So it is an extremely good risk-reward trade, given that it kind of works in both the extreme dovish scenario and in the extreme hawkish scenario from the Federal Reserve. I think the big risk to this trade is if we get a substantial worsening of the energy situation worldwide, given that Japan is a big net importer of energy. But Weston, in relation to the debate on whether the Federal Reserve will lean hawkish or dovish, you have an important point to make in terms of forward guidance, because essentially the Fed will likely not commit to anything at all tomorrow, will they?
I mean, they may, but is the market going to take them seriously? So Christine Lagarde killed off forward guidance officially. Like, she said, like, my September, whatever I said about September, like scrap that. It's not relevant anymore. We're going meeting to meeting. We're going month to month. We're going to be data dependent. Forward guidance is dead. Now, the Fed essentially killed forward guidance themselves by doing that inter-meeting Wall Street Journal, 75 basis point rate hike going into the June FOMC. So whatever they say, are like of course they're going to guide, but our market's going to take them seriously. And so that's the thing about a trade like this, or any sort of trade, any Fed related trade, which is basically everything at this point. From here forward, if forward guidance is dead, are people going to be like hooked onto every word of what Jay Powell says during press conferences? Press conferences matter anymore? How do we know if they even matter anymore? Like what market behavior is? Can we even tie that to what he's saying, or is that totally, unrelated? So we're in uncharted territory right now of not just whether or not forward guidance matters or not, and deciphering that, but whether or not we know if forward guidance matters at all.
If we take a look at the current pricing of the big central banks and start with the European Central Bank, we have a chart on today's pricing of the European Central Bank into next year. And it is quite visible from this chart that the market expects the ECB to continue to hike during the autumn, all the way until the early part of next year, with around 5 times 25 basis points in total being priced into the curve right now, on top of the 50 basis points that we already received was it last week. What do you make of the possibility of the European Central Bank hiking all the way until Q1 next year?
I think that it would be very interesting if they follow through with that, because if they follow through with that, then I think that they might have to implement this TPI, I suspect, as a offset. What was the acronym that you used for it?
I call it temporary protection of Italy.
Right.
so, I mean, it is obviously designed for Italy, maybe Greece, but I mean, we've had a lot of debate in recent weeks on whether Italy is eligible or not for protection via this bond purchasing program, and I have a fairly pragmatic view on that, because by the end of the day, the program is designed to protect countries like Italy. So as long as the European Commission holds no sort of cards against the ECB buying Italian bonds, and for now they don't, then the Italian bonds will be eligible in this program. And I perfectly agree with you. They will have to put this program into use should they hike interest rates during the autumn to the extent that is priced into the markets. And back to the discussion on the euro versus the yen, I think that makes for a really interesting risk reward in that currency pair, because it basically means that the European Central Bank is damned if they do and damned if they don't. If they hike interest rates, they will have to print new euros to protect Italy. And if they don't hike interest rates, they will disappoint the current market pricing, leading to an even weaker euro than what we already see now. Weston, if we look at the Federal Reserve, we can bring a chart up on the screens on the current Eurodollar curve pricing. And here we refer to the derivatives that you mentioned initially on dollar LIBOR. So this is the future pricing of the dollar LIBOR interest rate. And as you can see, we also have a market pricing expecting the Federal Reserve to pivot already during the first half of next year. Ultimately, we probably need the Fed to surprise on the dovish side even before then to have a rally in risk assets, don't you think?
Oh, certainly. I do. But again, the implied volatility on Eurodollar futures is just, I mean, I don't know if it's unprecedented. It certainly seems to be, or at least for, many decades going back. But that curve, that chart that you showed, I mean, if you showed that to me, I don't know, like 2 weeks ago, it would look very different, right? I mean, it just keeps shifting forward. And so essentially what that means is that rate cuts are coming sooner, right? I mean, they used to be out, the cuts were coming in June of 2023. Now they're, I guess, around, the January, the beginning of 23 and so on. So, again, so rate volatility, or front-end rate volatility, is going to affect the MOVE index, the VIX index, and all that too. So I think that, yeah, you're probably going to need, you're certainly going to need the Fed to back off in order to get some sort of breath of, or sigh of relief, rally for equities. But that's going to come with a lot of volatility. And so if there's spot up, VIX up, right? If there's basically volatility going up alongside the index going up, that's not a very sustainable rally for the equity, the indices in and of themselves. As long as it's being paired alongside rate volatility, that's going to be a very choppy market. It's a trader's market at best, and not really one for to rebuild a long-term long position and call a bottom on it, with rate vol at these levels.
Weston, I wanted to play a soundbite for you in relation to this discussion on the Eurodollar curve. It is from a discussion starring Mr. Eurodollar, Jeff Snyder, in discussion with Stephen Van Meter and Roger Hurst on the exact curvature of the Eurodollar curve. So let's look at the video clip and get back to the discussion.
You're right, Steve. The Fed in particular has said we're going to ignore Eurodollar futures. And the reason they want to ignore Eurodollar futures is because it tells them things they don't want to hear. It tells them they're wrong. And so they say, well, we can't be wrong. We're the Fed. We're never wrong, except they're wrong every time, and Eurodollar futures curves end up being right. The last time this happened, when the inversion was a fraction of what it is now, was in June, starting in June of 2018. Eurodollar futures began to invert in June of 2018. Remember, June of 2018, at the time, nobody thought the Fed was going to end up stopping. Jay Powell was almost as hawkish as he is now back in June of 2018. And Eurodollar futures began to price what ended up happening in 2019, which was a Fed pivot into rate cuts that nobody saw coming except this entire market. You can go back to 2006. The Eurodollar futures curve, like the Treasury curve, they predicted not just that there was going to be the global financial crisis, but also could tell you about when it was coming, because the Eurodollar futures inversion, like the Treasury inversion, grew steeper. It moved further up toward the front of the curve as we got closer and closer to that crisis and that recession. Eurodollar futures in 1999 even, 99 and 2000 predicted the dot-com recession. So Eurodollar futures, unlike the Federal Reserve, has an actually envious track record of being able to predict these things. And the problem is the Federal Reserve wants to dismiss all of these financial signals for whatever hand-waving reasons that they can come up with, simply because the financial markets are disagreeing with everything that the Fed is doing, as well as their interpretations of economic circumstances.
The entire discussion between Jeff Snyder, Roger Hurst, and Stephen Van Meter is available for subscribers at the Real Vision platform. But Weston, back to you. Jeff Snyder basically says here that the Eurodollar curve is screaming to the Federal Reserve to pivot. What do you make of that discussion?
So I just first and foremost will say that I think Jeff is very brilliant and knows this subject in and out. And so I'm not going to challenge him per se. I'm just going to just accept that he knows more than me, and he always will. That said, though, here's what I will say. My sort of pushback, I guess, would be that I think that I don't know that the Fed doesn't know necessarily about the these like futures curves, or that they're ignoring them on purpose. I think that they would like to perhaps act on them, but if they do, they'll just be completely at the whim of the markets, with the markets knowing that. And they need to exert some sort of, or at least attempt to exert some sort of control over the situations. You don't fight the Fed, like that whole narrative, like that needs to reinstate itself. And so I think that it's not a matter of ignorance necessarily. It's a matter of what they can and should do in terms of their policy communication. Not that has been particularly good. One more point I want to just mention. I mentioned this with Maggie Lake on the daily briefing last week as well. But with regards to this temporary Italy protection program, this yield spread control program, if the ECB wants to take any notes or take any cues from the BOJ, they need to be very careful as to when they do it, because markets have no idea at what level, at what price level, what Bund and BTP spread level is going to call for this action to take place. So reminds me of BOJ back in September of 2016. They announced yield curve control. Nobody knew what the hell that was. It was very new. And then it was like 6 months later, in February of 2017, when they first actually did it. And they did it. It happened to be when 10-year JGB yields were at 10 basis points. And once they did it, 10 basis points then became the market's level, the set level. And then they went plus and minus 10 basis points and set this target range. range never existed. The concept never existed before, but markets did it, and then the BOJ got forced into adopting it. And now here they are defending 25 basis points, like like their life depends on it. And so the ECB needs to be very careful as to when they do it and what price level. It has to be, they have to be very conscious of that, because markets will just cling to that immediately and nail them down to that price level.
Yeah, and they obviously haven't firmed up that level in Italian bonds yet. So my take is basically to be short Italian bonds until the ECB tells you not to be, to be very firm. I wanted to discuss with you also how to position in various asset classes ahead of the Federal Reserve meeting. And one thing I've noted is the mixed signals that we receive from various companies currently. If we look at the report from Walmart, they basically told us that they see demand destruction in certain categories now. They tell us that the inflation that we see in the food category basically leads to consumers not buying merchandise and clothing, for example, at Walmart stores, while at the same time McDonald's is telling us today that they are faced with around 10% wage inflation. How would you position in equity markets if you want any positions at all ahead of this Federal Reserve meeting?
Yeah, I mean, I want to defer back to you on that. I know that you have a sector pair idea. What I will say though, regarding like what happened with Walmart and their pre-announcement, if you will. So there's an individual, for those who don't know, Brad Snyder. He is a Real Vision member. He's a truck driver. He's a good friend of mine. We have the show called Exchanging Lanes that we did on an episode a few months ago, 6 months ago, on YouTube, Real Vision YouTube, and the link is out there. And basically, we talk about this. He basically is the best macro indicator, as in he's not an indicator of anything. He's seeing things in real time, and he's basically giving us what's happening on the ground in the American economy in real time. He has the most sort of broad overview due to his job, and then being able to see week over week changes across a wide array of geographies and industries and so on and so forth. But something that he was talking about 6 months ago that he brought up that nobody else was at the time was this concept of this excess inventory. And though what we were discussing at the time, it didn't play out exactly to this degree, that is an issue that Walmart, and not just Walmart, but Walmart and the other retailers, and even Amazon stock was down today on these concerns, are currently facing. So just want to give a shout out to Brad on that for fantastic heads up on that. But Andreas, give us what's the trade, I guess the sector trade that you were talking about, this long short?
I mean, demand destruction is visible across the board right now. The retailers are telling us about it, but we can also see it in macro data. And if we look at the best macro indicator, I think, of demand, the weekly wages adjusted for inflation, then we have a crystal clear signal currently. Wages adjusted for inflation, they're falling off a cliff. And to me, that is a signal that the consumer discretionary sector will continue to suffer. Essentially, when wages are falling off a cliff adjusted for inflation, you buy stuff that you need and you don't spend on luxury goods, right? So it's a trade that I've had on for quite a while, being short the consumer discretionary ETF versus being long consumer staples. So actually long Walmart versus, for example, Tesla. Those are like two big positions in that relative bet. And I think it will continue to work as a consequence of the demand destruction that is ongoing. The Federal Reserve is telling us that they want demand destruction. They want to continue to see demand destruction during the autumn to ensure that inflation comes down. And by the end of the day, that will lead PMIs lower compared to current levels. And I have a bar chart on the sensitivity across various equity sectors to the ISM index, the ISM PMI index. And it is an interesting conclusion when you look at that bar chart, because the sector that is the least vulnerable to falling PMIs is basically consumer staples or the utility sector, while stuff like consumer discretionary with a lot of tech and luxury goods within that basket is much more vulnerable to the PMI falling. So that could be one way of playing a continuously hawkish Federal Reserve over the course of the autumn and the late summer here. If we look at the current macro data, Weston, I also want to show a chart on the retail sales volumes compared to the retail sales non-adjusted for inflation. I see that Brian brings up this the chart now. I think that's a very important point to make to people out there right now, that you need to inflation adjust every single number that you look at. Because if you look at numbers that are not adjusted for inflation, they will all look extremely elevated, right? And I think that's something to bear in mind during the reporting season as well, that top line numbers will look almost extremely elevated as a consequence of inflation. But if volumes are dropping, then it's not necessarily a positive story for growth anyway. Weston, I think we have time for a couple of questions from the audience as well. Fred asks us whether we think that once the Fed acts tomorrow, whether we will see additional action from the ECB or the Bank of Japan soon thereafter. What's your take on that?
No, well, not like, I don't think that the ECB or the BOJ will be shocked in any way by what the Fed does, even if they go 100 basis points. This is what Governor Croda, at least, is, like I said, hoping for, if not expecting at the very least. The ECB front-loaded, probably expecting some sort of, if anything, the Fed might be following ECB, in this particular, round. But no, I don't think that's what will happen. I think that if anything, it'd be a surprise if they were taken to be dovish.
If we look at the developments today in markets, we had quite a material repricing of the natural gas price in the US after the news emerged that the European Union will have to sort of ration gas across the Union to ensure that storages will basically hold through the winter season. We know that both Japan and big countries within the Eurozone are big importers of energy. How resilient is the Japanese economy to a continued rise in energy prices?
It's not.
No,
it's not resilient. So, but the real problem is, so like Japan is the one risk to buying calls on the yen or playing the yen upside. Is that Japan, the yen can continue to weaken strictly off of just Japan having to buy spot LNG at ever higher, costs, and doing so, crowding out EM, Asia EM basically, who are unfortunately going to be outbid by the likes of Japan and so on and so forth. But no, Japan is completely energy unsustainable on its own and needs to import just as much as Europe needs to. And then things that are happening with like Nord Stream 1 and all that, with Europe and 20% capacity, all that does also flow out into like LNG pricing and supply and demand for Asia as well, and directly to Japan. So it's all very much interconnected, which therefore then ties in the euro, the yen, and all that as well. So it's all this one big sort of loop. What's your take on that? You're living it more so than I am. So,
I mean, if we look at current storage levels in the Eurozone, they are basically far from being full on natural gas. In particular, if we look towards Germany, the Netherlands, and a couple of Eastern European countries. So it is a tricky situation, and I think Putin holds the upper hand in that negotiation. But I ultimately think that the Eurozone will cave into his demands and ensure that the gas will flow during the winter season, because they have no other options by the end of the day. Interestingly, I think it's tradable basically if you look at the commodity sector, because for now it may make sense to continue to be long energy, so natural gas and oil, in a spread trade versus industrial metals. And the reason why is that the Chinese economy suffers big time. And I want your opinion on that as well. Let's put up the chart on Chinese consumer confidence. I think we got that number a couple of days ago, and it looks absolutely abysmal, the recent consumer confidence data from China. And we know that the Chinese economy is very interlinked to the industrial metal space, Weston.
That is one hell of a chart. Jeez. That's interesting. I haven't actually thought of that. But your energy versus metals trade, and then with China, I think that's I would have to look at that through the lens of the yuan, especially with base metals and all that. But I mean, we're also seeing some developments happening once again with like the lever grants coming up, and so if the property development sector, if people are boycotting mortgage payments and all that kind of thing, and the property development sector is crashing in China, that could be certainly a very tradable metals complex, and then it would be almost not independent per se, but it would diverge or be differently sourced from the energy side of it as well. So something to look into for sure. Yeah.
Yeah. I've had at least a decent couple of months in my portfolio compared to the beginning of the year. I had an awful beginning of the year, and therefore today's meme, as you know, I've made it my trademark to always conclude the show with the meme, refers to that better performance of my portfolio. Not sure if I'm a better trader or the market stopped going down. Maybe it's a combination. I don't know. But I guess that concludes the show for today. Weston, a pleasure to talk to you again.
Yeah, pleasure's all mine. Thanks so much, Andreas.
We will be back tomorrow with all the action surrounding the Federal Reserve meeting. It will be a huge day. Uncertainty is elevated, but let's see whether the Federal Reserve will actually dare to guide us at tomorrow's meeting. I will be back with Darius Dale tomorrow to basically boil down all of the action. Thanks for watching today.